You spend 20 minutes hunting down a $20 mismatch in your trial balance, you finally get the columns to match, and you walk out of the exam feeling victorious. Then the results come back, and you've lost massive points on the long answer questions. The disconnect here is incredibly common. It happens because we are trained to treat accounting as a pure math test, but Cambridge examiners treat the math as a basic prerequisite. The real grade is decided by your theoretical analysis. The central trap is that a perfectly balanced financial statement gives off an aura of total accuracy. If the debits equal the credits, it feels like an absolute truth about the health of the company. But the standardized rules that make those ledgers so beautifully clean are exactly what makes them blind to reality. To make numbers fit perfectly into columns, accountants have to strip away a massive amount of real-world context. Accepting that a mathematically balanced book is not the same thing as a healthy business is the actual starting point for A-grade analysis. To evaluate a business effectively, you have to realize that a single sheet of accounting data tells 5 completely different stories, depending on who is holding it. This diagram illustrates the core audience for any financial statement. We have one central document, but it has to serve 5 distinct masters: owners, managers, banks, credit vendors, and tax authorities. For the owners, this document is a report card on their capital. They are scanning the return on capital employed to see if their initial investment is actually generating wealth, or if their money would be safer in a savings account. The internal managers are looking at the exact same numbers, but they are hunting for operational friction. They need to extract specific efficiency metrics, like inventory turnover, to figure out where to cut costs next quarter. Banks and trade suppliers don't care about the long-term growth strategy. They are entirely focused on short-term liquidity. They calculate the acid test ratio to measure the exact probability of default before they hand over a loan or a batch of inventory on credit. And the tax authority only cares about standardization. They need a rigid, objective calculation of profit so they can assess legal tax liabilities without managers hiding cash in creative accounting. The mistake most candidates make is memorizing the formulas these groups use, but failing to question the raw data being fed into those formulas. By attempting to satisfy 5 different groups with one rigid set of rules, financial statements end up missing the specific, real-world variables that each stakeholder actually needs to see. The first major theoretical blind spot ruining your evaluation marks is the principle of historic cost. This principle enforces a strict input rule. Whenever a business acquires an asset, it must be recorded in the books at its exact original purchase price, and it stays at that baseline cost. The logic here is sound. A receipt provides objective, stable proof of a transaction. It eliminates guesswork and allows independent auditors to verify the numbers. As you can see, an asset bought in year 1 sits at original cost, even if replacement value in year 5 doubles. Imagine a bank manager assessing collateral on that year 1 figure. They make a high-risk decision based on non-existent value. In written exams, candidates often calculate a business's long-term non-current assets and pronounce the company highly stable. They lose points because they fail to warn imaginary stakeholders that replacing those aging assets will cost significantly more cash than the balance sheet implies. This inability to apply accounting principles causes low scores. Look at this June 2024 examiner report. For question 35, many candidates struggled specifically with the realization principle, the rule dictating exactly when value is recognized, regardless of when cash is banked. Calculating the historic cost earns the baseline marks. Adding the inflationary reality to your analysis is what distinguishes an A-grade response. The second major blind spot is the money measurement principle. This rule dictates that accountants are only allowed to record transactions that have a definitive, objective monetary value. If you can't put a solid dollar amount on it, it doesn't go in the ledger. Again, the intention is protective. It stops overly optimistic managers from inventing artificial value to inflate the perceived worth of their company on paper. A spreadsheet excludes operational realities. Variables like staff morale don't fit the cells because they lack a price tag. If a rival launches a product or staff strikes, the ledger stays perfectly balanced. Investors relying strictly on this are effectively flying blind. This is the exact trap in an exam advisory question. You might perfectly calculate a soaring gross profit margin, But if you recommend rapid expansion without pointing out that the business relies on an overworked, unhappy staff, your advice is practically useless. Objective numbers only tell a stakeholder what happened yesterday. The qualitative, non-financial realities dictate what will happen tomorrow. Examiners demand you evaluate both. So, how do we translate these theoretical limitations into a reliable strategy for written advisory questions? We use a specific 3-part methodology designed to secure maximum evaluation marks. It looks like this. Step 1 is your baseline. You calculate the required profitability ratio or variance accurately, proving you have the technical skill. Step 2, explicitly name the specific stakeholder relying on this data. Tell the examiner exactly why the owner, the bank, or the manager cares about this specific metric. Step 3, name the limitation. Confidently state how the money measurement principle or historic cost is currently limiting the usefulness of that data for that specific stakeholder. Handing an examiner a perfect calculation only proves you know how to do bookkeeping. It yields an average score. Using this dual approach, balancing the math with a critique of its limitations, moves an answer into the territory of top-tier analytical evaluation. Knowing this 3-part formula is the easy part. Executing it rapidly under the pressure of a ticking exam clock requires repetition. That is why we built a dedicated module specifically to drill these high-mark theory scenarios using real past papers. Go to studybuddy.tech, master the limitations of the ledger, and stop losing your evaluation points to the illusion of accuracy.